Live from New York City this morning. Good morning, good morning. For our audience worldwide, equity futures just about unchanged. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, we begin with the big issue. The yield curve signals a recession is brewing.
There's a lot of signals.
A significant amount of signal in the yield curve.
2s, 10s, that inverted. Fed funds 10s now inverted with further hikes coming.
The inversion is coming from the long end of the curve.
The yield curve is definitely telling you a recession is coming.
We will have a recession. The 3-month to 10-year tells you that.
Right now, we respect that signal.
You're supposed to watch the yield curve.
It's inverted in almost every area.
It's the market telling you something.
The market is perceiving that the Fed is going to have to over-tighten and really send this economy into recession.
The Fed may be vulnerable to going too far here.
The market believes that we're likely entering in a recession.
It's not here yet, but the check is certainly in the mail.
The check is in the mail. Joining us now is Nuveen's Tony Rodriguez and Gershon Distenfeld of AllianceBernstein. Tony, I want to go straight to you. Just how much signal is there in that yield curve?
Good morning, Jonathan. Good to be with you. I think it's a very strong signal and one that certainly we and I think the markets need to take very seriously. No matter what curve you look at, 2s, 10s, 3-month bills, 10s, 3 months, 18 months forward, which the Fed likes to look at, all are inverted, and I think all are sending the same signal. Our view is that we are likely to see a recession. I think really the more important discussion is around how deep and how long that recession may be. We happen to be in the camp that it's going to be a relatively mild and short recession. And of course, that changes the dynamics of your portfolio construction. But it is a very serious signal, and we think an accurate signal.
Gershon, do you agree?
I think Tony said something very insightful there. I think we all believe there's going to be a recession. I know almost no one. I was at a dinner with investors hosted at Bank of America last night, and everyone thought we were going through a recession. The question is, how deep is it going to be? I also look at the yield curve a little bit differently. I try and be a little more positive about what it's telling us. What it's telling us is the Fed is, at the end of the day, going to be successful in bringing down inflation. Because if the market felt like they weren't, that we're going to have persistently high inflation, you would see long-term rates a lot higher. So I try and judge the yield curve a little more favorably.
Well, the question is, Gershon, at what cost? At what cost will it take in GDP to get inflation back towards target?
That's an open question. That's what the Fed is really trying to debate here. You know, we're all sitting and trying to figure out, are they going to go 50, 25 the next move? You can make an argument either way, either camp. You can say we know that monetary policy works with a lag, therefore we should keep on going. We should pause because we're gonna overdo it. On the other hand, the Fed's credibility is at stake. What we think is going to be much more important is not what they do now. It's do they have the discipline to hold rates, right? The market is now pricing in, or has been pricing in for a while, rate cuts at the end of 23. Is that a mistake? That was the mistake that was made in the 80s. The Fed ended up cutting rates too soon, and they had to jack rates up tremendously. I'm not suggesting we're in the period of the 80s right now, but that's the dilemma the Fed's going to have, and they're going to have to weigh the data that comes in, both on the inflation side and on the growth side, to try and figure out where to go from here.
They're talking about risk management. The Cleveland Fed President, Loretta Mester, speaking to the FT yesterday, I've quoted her a few times. She said this: it's very easy to be caught out by the good news, but we don't want wishful thinking to take the place of really compelling evidence. The costs of stopping too early are high. We want to be very diligent about this. Tony, does that quote tell you that this yield curve can get a whole lot more inverted than it already is?
Jonathan, we do think that it's possible that we get a bit more inverted. I mean, we've seen the curve get to around 100 basis points at times. It's pretty rare, however. I think really what the quote tells me more is that the decision for the Fed is going to be about holding rates at a high level, whether that's a 4 3/4 to 5% funds rate or a 5 1/4 to 5.5% funds rate. It's going to be about holding it throughout 2023. Right now, we think the markets are maybe a bit too either optimistic about the Fed pivoting or pessimistic about how deep the recession will be, therefore causing the Fed to pivot sooner in 23. So we think the pricing for Fed cuts in the second half, fourth quarter of 23 is a little bit too optimistic. Our base case would be that at the earliest you would see a Fed cut would be at the very end of 23, but it's more likely to be a 2024 scenario for Fed cuts, that they will be patient, given that we think they're going to need to be, because inflation is going to be sticky throughout next year.
So, Tony, let's talk investment implications. You've said two things in the last 5 minutes. One, you said recession short and shallow. Two, you said the Fed and Fed funds could stay high for a whole lot longer than people think. So what are the investment implications of a Fed that stays at, say, 5% through next year? At the same time, we get a recession, even if it is short and shallow.
Sure. So, John, I think there's two implications primarily. One is with respect to how you position for rates. And our view is that at the long end, rates have really made the majority of the move. We don't expect to see much higher rates than where we are today, and we expect to see lower rates than where we are today in the long end of the curve by the time we get to the second half of next year. So we think you can be comfortable around taking rate risk at this point. When it comes to kind of risk assets and spread risk, there is where I think there's also a message being sent that we think it's okay, given that shallow recession and strong corporate fundamentals, to be in investment grade credit and the higher quality segments of below investment grade sectors like high yield, leveraged loans, emerging markets, where we think you need to be careful because of that. Holding rates for longer is in the very low quality end of all of those higher risk, higher volatility segments of the market.
We'll pick up on that theme in just a moment. Equity futures right now just about unchanged on the S&P 500. We're positive by a couple of tenths of 1%. On the Nasdaq, that move sticks just about up by 0.2%. Ton of Fed speak still to come this week, including Chairman Powell tomorrow. Then on to payrolls on Friday. Mike McKee, you'll be breaking it down for us.
Yeah, and John, you give speeches. You know what the instructions are for framing your message. You tell them what you're going to tell them, and then tell them what you told them. And that's pretty much where we are with the Fed. You go back to November 2nd at the press conference, Jay Powell came out and said, the ultimate level of interest rates will be higher than previously expected. Well, it's been almost a month now, and the message is still the same. Not a massive change, but somewhat higher, John Williams said yesterday, endorsing that view. And Jim Bullard saying the FOMC will have to be more aggressive rather than less. So what is it that Jay Powell can add to the conversation? Probably not a whole lot. The market has pretty firmly priced in the idea of a 50 basis point, half a percentage point move at the December 14th meeting. And it's unlikely that Powell will dissuade people from that. The question is, does he give any advice about that terminal rate you guys were talking about and how long they'll hold it there? Williams yesterday saying throughout 2023. Now, what could change the market's minds between now and December 14th? Economic data, and there's some serious data coming out. Tomorrow jolts. The Fed's whole argument has been that the labor market is tight because there are a lot of job openings. Is that still the case? PCE inflation is what the Fed follows, and it's going to come down in a different way than CPI because housing isn't such a big deal in PCE. The jobs report we're talking about now, a lot of people are going to look at the unemployment rate, but that's a lagging indicator. You can go many months before it starts to rise when the Fed is in a tightening cycle. CPI, that's going to be the one that gets everybody's attention. It's the day before the Fed decision is announced. Unfortunately, it's the day before the Fed's decision's announced. So we won't know from anybody at the Fed what they think about it until we get that 2 p.m. December 14th decision. One interesting thing, and since you quoted the Financial Times, I want to point out one piece today by Robin Wigglesworth, who, by the way, has a great cartoon in connection with this, and it's worth looking at, but basically saying, what if we do have a recession? We've had them before, and everything turned out okay. Interesting question.
Love Robin. It's great. You didn't fit Team USA in there, Mike McKee, on the calendar. I thought it might fit in later on this afternoon.
Well, I think we got to get through this afternoon for it to be relevant by the time we get around to the next Fed meeting.
Fingers crossed.
Data.
I think we can make it happen. Mike McKee, great to catch up with you as always, sir. Gershon, I want to come back to you about the economic data and the markets. Do you think there's a bit of a disconnect right now between what you're seeing in, say, the PMIs and what you're seeing in spreads?
Yeah, no doubt. But just before that, I want to say I'm glad that you're rooting for the USA, John. I don't know who you were rooting for last Friday, but I'm very happy you're rooting for USA. So
I'm on board, totally on board.
Okay. Well, you know, us USA people, we're soccer fans once every 4 years. Anyway, yes, I do think there's a disconnect. especially you mentioned the PMI. It's exactly, PMI actually has one of the highest correlations to high yield spreads. And a PMI of just north of 50 is indicating that we're likely to go into recession, and spreads probably should be wider given that. So you know, John, that I'm a long-term bull on high yield. I do think that at these levels, given the starting point, we're going to have some pretty attractive returns coming up. But I am concerned in the near term about spreads in this marketplace, and do think we can go wider in the short term.
So you don't think PMIs improve here, Gershon? You think it's spreads that have to give?
Well, I should have caveated that, John. You're right. If we don't see PMI improve, there is a disconnect. So if PMI does improve, then spreads are supported and they could even go tighter. I was making the assumption that we weren't going to see PMI improve.
When you see the time horizon of, say, 3 to 5 years, is that what you're thinking about, Gershon, to make this work now, to buy now and wait for that kind of time period? What's your time horizon for that trade?
I was thinking a little bit shorter, John, maybe in the 1 to 3 year period, but you do make a good point in that 5 years is actually a good time horizon. It's a little bit longer than the duration of the high yield market. We misuse duration in fixed income. We think it means all sorts of things. What it really means is how fast does my portfolio turn over? And that means that you should earn your yield over time minus any losses that you're going to have. So we're starting with yields at 9.5%, let's call it. And let's assume some really drastic losses. I think it's more than I'm expecting, like a 5-6% default rate, 50-cent recovery. You're still looking at 5 to 7% return. So yeah, I do think the long-term investor is going to be rewarded here, but there's going to be continued volatility in the short term.
Tony, final word on this one?
Yeah, so I agree with Gershon on the two of those notes. One is that we do think that there are going to be better entry points over the next 1 to 2 quarters. So we do think spreads need to widen to reflect the PMI data and the weakness that we're expecting in the economy. But we do think that at that point, it will be a very attractive entry point for credit risk. And if you take it today, we do think that over a 1 to 3 year horizon, you will make money. But we do think there'll be better entry points with wider spreads over the next couple of quarters.
Hey, Tony, stick with us. Tony Rodriguez alongside Gershon Distenfeld. Coming up on this program, strike risk threatening to undo Biden's rail deal.
I am very pleased to announce a tentative labor agreement that has been reached between the railroad workers and the railway companies. This agreement is a big win for America.
The tone has changed down in Washington since then. That conversation up next.
I am very pleased to announce a tentative labor agreement that has been reached between the railroad workers and the railway companies. This agreement is a big win for America and for both the American people. This agreement can avert the significant damage that any shutdown would have brought. Our nation's rail system is the backbone of our supply chain.
That was September. Almost 3 months later, several unions failing to sign up to it, and President Biden calling on Congress to prevent a national railroad strike. Speaker Pelosi saying the House will consider sending a bill to the Senate this week with no poison pills or changes to already negotiated terms. For more, let's get to AMH down in Washington, D.C. Anne-Marie, how tense is this one getting?
Well, it's getting very tense, but Jonathan, we need to remember when the president was speaking in September, and I was there in that Rose Garden announcement talking to some of the both sides with the union and the companies. The fact is it was tentative. That was the key word, a tentative agreement. You have these labor unions that needed to sign off on these 13 agreements. 12 agreements were signed off on them, 4 were not. And what the heart of this issue, and it comes down to, is sick leave. These workers want paid medical leave. But right now, it's a tricky moment for the president. A key part of his statement last night I want to bring you is he says, as a proud pro-labor president, I am reluctant to override the ratification procedures and the views of those who voted against the agreement. But in this case, where the economic impact of a shutdown would hurt millions of other working people and families, I believe Congress must use its powers to adopt this deal. So the president leaning into the fact that this would just devastate the U.S. economy if there was supposed to be a rail strike, and he wants Congress to override the fact that some of these unions voted down these agreements, and he wants to make sure they can avoid this strike.
At 10:30 Eastern Time, interesting meeting just dropped on the calendar, didn't it, for the president a little bit later this morning?
Yep, that's right. We just got word from the White House that the president's going to be convening with leaders of Congress. Likely, this will be #1 on the list, along with a number of legislative issues that this administration wants to see get done before they lose control of the House come in the next Congress next year. So that would be one, funding the government, Jonathan. Don't forget, we still have to fund the government. The stopgap funding measure, that's going to be ending in December. On top of that, they want to get same-sex marriage laws passed, potentially some election laws passed. But for them right now, really key is going to be making sure they can avoid this rail strike.
Wall Street weighing in on this already. Andrew Hollenhorst of Citi, Anne-Marie, had this to say a little bit earlier this morning. I'll read the quote for you. The House, urged by President Biden, will move forward with legislation to force rail worker unions to accept an agreement that includes a 25% wage increase over 5 years after 4 of 8 unions failed to approve it earlier. With a deadline of December 9th and a 60-vote threshold in the Senate, passing the legislation may be difficult. A potential alternative would be lengthening the cooling off period. Anne-Marie, can you help us frame just how difficult it would be to get over that hurdle?
Well, there are some Republicans who are going to agree with the president. They want to avoid this as well. They realize that this can be devastating for the economy, especially inflation is high. This is still top of mind for everyone's voting memberships, right? All their electorate, as well as the fact, Jonathan, that we're going into the holiday season. But you also may have, that's the Republican side that may come and join this, and likely many will. But then you have progressives from the president's own party who are going to want to line up behind workers' rights and say that even though they're getting wage increases, the fact of the matter is these individuals are asking for sick leave, especially when you talk to labor workers. They say we were there during the pandemic and working during COVID when most people were working from home. They kept the economy really running. So you're going to have progressives like Senator Bernie Sanders potentially wanting to vote against this unless there's any movement on sick leave.
AMH, great work as always down in Washington. Great to have you back in the seat as well. Look out for our conversation with the Labour Secretary, Marty Walsh, a little bit later this week. Due to catch up with him on Friday. Typically catch up with him around payroll. So waiting for that to be confirmed, but expecting that conversation to take place, and a big conversation around negotiations with unions, not just over rail, but also on the West Coast at certain ports as well. Looking ahead to payrolls Friday, the estimate in our survey so far, moving target always is, but at the moment the median in our survey is 200K. The previous number was 261,000. Tony Rodriguez and Gershon Distenfeld is back with us. Tony, I want to come to you on that. Your expectations for this labour market going into next year?
So we expect to see some softening in the labor market, but we don't expect to see a real collapse. And I think that's kind of what the Fed is hoping for in their own soft landing scenario, is that ideally they would see the softening of the labor market come more from a reduction in job openings, for example, and that would help ease some of the wage pressures. Because the ideal scenario for the Fed is that as we move into the middle of next year, that you'll have inflation coming off such that wage gains, while not increasing, can be above inflation. So that we'll actually have positive real wages. So that's the ideal scenario. We do think you will see that softening in the labor market. We're just not quite as confident that it's going to be the soft landing to the labor market and avoid a recession, hence our base case of mild recession kind of in the middle of 23.
Tony, how instructive do you think job openings data is, JOLTS data? Now, I understand it matters because it matters to the Fed. So, of course, it matters to us for that reason. We want to understand what it means for policy. But, Tony, how instructive do you actually think it is? Do you think it's a decent reflection of what's happening in this labour market?
You know, Jonathan, I would say that it's a mixed story. So I don't think it's as important as the Fed has given it importance as a result of Powell's speeches and his focus on the number. However, I do think it does give us some useful information about job openings that are out there, and hence the demand for labor exceeding the supply. So we look at that, we look at the labor force participation, and then we actually look at the job gains that we're seeing from companies in the monthly labor report. I would say that the actual job gains is still more important, but you can't completely dismiss the JOLTS data.
It's the trillion-dollar question, isn't it, Gershon? Can you rebalance this labour market without sending unemployment a whole lot higher from here?
I think the answer is no. And the question is just how much. I must be an outlier here because I actually don't think that the numbers we see this month or even next month are all that significant. We know monetary policy works with a lag. We only got to 2% on the Fed funds rate in August, 3% in October. So that's not very, very restrictive. I think the real thing, I know markets are going to focus, you have to focus on the data you have in front of you. What's going to matter is as we get into the first quarter and the second quarter, what's that going to be? And that's the dangerous game the Fed is playing right now, and they have no choice, is they don't know what the right terminal rate is. They don't know how far they're going to push, but you don't get instant feedback on that. It takes months, if not maybe a year sometimes, to see that. And so it's a guessing game. It's a little bit of feel. I know markets don't like that. Markets want certainty. Markets are going to parse, every bit of data that comes out. But the fact that monetary policy works on a lag just limits how much we actually know about what's happening right now.
And Gershon, to make it even more problematic, the one place they get instant feedback from is the market, and financial conditions have been easing. Doesn't that just mean they double down going into next year?
Yeah, maybe, John. I'll tell you what I'm looking for. And I thought we were getting a little bit of it yesterday morning, but then it quickly reversed. We've been in this pattern for the past almost year where we've seen the correlation between equities and treasuries break down. Normally when equities are selling off, treasuries are rallying. And we know why it happened, because of inflation. When we start to get a more of a normal environment where bad news means that the long end of the curve rallies, that's when we know that we're probably in a better scenario. And to the discussion we had earlier, I think then the yield curve could get even more inverted because the Fed is going to have short-term rates high, so short-term rates have to be high. But the market will be convinced that it's going to cause a significant slowdown, and you're going to see long rates rally. I think that's the signal that we need to look for in markets.
Some Amazon debt on sale today as well. We'll talk about that another time. Tony Rodriguez and Gershon Distenfeld, to the two of you, thank you. Off the back of that announcement, yields a bit higher in treasuries. 10-year yields higher by 7 basis points. The 2-year up by about 3 basis points. Equity futures this morning unchanged now on the S&P 500. Coming up in the morning calls and later, Goldman, Deutsche Bank, Barclays, all sounding the alarm on the equity rally. G-Square's Victoria Green echoing that view, expecting the S&P to hit a low of 3,200 potentially in Q1. More on that conversation around the opening bell. Tuesday morning, good morning to you. About 20 seconds away from the opening bell, equity futures look like this, just about unchanged on the S&P 500. On the Nasdaq 100, up by not even 0.1% going into the opening bell. Now on the Russell, the small caps, pretty much unchanged as well. From New York, your opening bell just about to ring. There it is. Get to the bond market. Treasury yields look a little something like this on a 10-year, higher by 6 or 7 basis points. That turnaround in the last hour or so. There will be a multi-bond deal coming from Amazon a little bit later. We'll give you the pricing of that when we get it. Euro dollar 103.30, negative 0.1%. Some better news for the Europeans, I guess. Softer CPI out of Spain. Things easing up a little bit out of Germany as well, relative to the previous month. The next stop for the ECB, December 15th. Crude looks like this, 78.76. We're positive there by about 2%. On the S&P then, about 25 seconds into the session, we are negative by just 0.04% on the S&P. On the Nasdaq, we're positive by just 0.03%. Wall Street casting some doubt on the recent rally. Goldman Sachs warning that stocks aren't accurately pricing in the risk of recession. Kaylee Lyons has more. Hey, Kaylee.
Hey, John. Well, the recent rally has really been over the course of the month of November, but really it goes back to October 12th. Since we put in that low, the S&P is up more than 10%, about 2% of that coming in the month of November. And actually, since the Nasdaq 100 reached its low early this month, it's up about 8%. So likely some degree of support provided here by the fact that the 10-year yield is 26 basis points lower today than it was when we started the month. It actually was on pace for its biggest monthly drop since March of 2020. So that rally in bonds has been much more substantial than the one for stocks. But inevitably for stocks, we have a chorus of voices saying that this rally is overdone, including Barclays, which said it's just seasonal. It's mainly driven by short covering. And Goldman, as you mentioned, saying that stocks are not accurately pricing in the risk of a recession. They say there's about a 39% probability of a slowdown in the U.S. in the next 12 months, while risk assets are only pricing in 11%. So they prefer bonds over stocks overall and expect the S&P is going to end the year just above where we are now at 4,000, which is the median consensus on the street. The average is actually about 2% lower at 39. 31. And there is a lot on the street who think we could go even lower on the way there. Binky Chada over at Deutsche Bank says we'll see a drop to 32.50, which is 19% below current levels in the third quarter as a recession begins. Morgan Stanley saying we could drop by as much as 15% by March because of QT. And Bank of America also expects the S&P will put in a bottom partway through the year and then rebound to end basically where we are now by the end of 2023. And at Bank of America, they are differentiating within stocks in terms of market cap. They like small caps here. Jill Carey-Hall and the team noting that those smaller stocks are already trading at recessionary multiples, and therefore they think that downside next year looks a lot more limited relative to large caps. John.
Katie, I'm doing a survey. Does a college football loving Katie Lyons watch Team USA a little bit later?
Yes.
Oh, my goodness.
I think it's during my crypto show.
Was that about how enthusiastic you could be? It's not. Your crypto show will finish by then,
Okay.
2 p.m. Eastern.
I prefer U.S. football.
Katie, go.
NFL.
Okay,
college.
forget I ever asked. Katie Lyons, thank you. You've been warned. This is about to get very bearish. Listen to this quote from Victoria Green at G Squared. The relief rally is petering out, and we're still in a bear market. We've had 4 of these bounces prior to this one, but still hitting lower highs, which will lead to lower lows. We're looking for the S&P to hit 3,400 to 3,200 before getting excited. Victoria joins us now. Victoria, that could be 20% away. Can you walk me through what's going to take us down to those kind of levels?
Well, sure. I mean, it's all about the earnings math and where we are with multiples. Yeah, the market came down, but earnings came down as well. So you're really not that cheap. So we think there's another shoe to drop here. We think seasonality got pulled forward a little bit. So we got an early Santa Claus rally. You know, it's kind of like Mariah Carey and Thanksgiving. Christmas is happening earlier and earlier. I think the Santa Claus rally's already happened. So I think there's a lot of risk right now in the markets. We didn't invalidate the chart. The dollar bounced off. You know, I know that right now everybody on the street, it's fashionable to say dollar's bull is done next year. But right now the dollar's still in an uptrend, the market's still in a bear market. We haven't invalidated the pattern. And when you see this pattern, we did this summer. From June to August, we went up 17% and then came right back down. Every time we put in a lower high, which you saw us hit these resistances and bounce off of them, I think that gives more fuel to the fire. This is a traditional bear market rally, and there's still downside risk.
We'll get deeper into the equity story in just a moment. You brought up the dollar. What's the dollar in an uptrend against still? Euro dollar has gone from the lows of the year from about 95 at the end of September to 103. Cable sterling's gone from 103.50 intraday back at the end of September to 120. What's it in an uptrend against?
Well, we're still going to see tightening rates, and I know maybe the Eurozone with the inflationary picture over there is possibly going to be more hawkish than we are, but listen to what the Fed is saying, especially Bullard. I know he's the uber hawk on the street, but as long as we're still tightening, as long as we're still raising rates, as long as the dollar is the place to be in the safe haven, I think you still see support there, as well as we bounced off that 200-day moving average. So again, you're not invalidating any patterns yet. So yes, there is some pressure. You've seen a lot of calls recently this week on the street saying this era of dollar bull is dead. I think it was JP Morgan and Morgan Stanley saying that, and we need to look at emerging markets and the euro currencies. But if I look at the Eurozone and how much trouble they're in with inflation, I'm just not excited about buying the euro yet.
And that's why we've had a performance in European equities up by more than 20% since the end of September. These relief rallies, they get sold and they get sold again, and we keep waiting for a Fed pivot that doesn't transpire. Victoria, Bank of America and Savita Subramaniam, I think on the same page as you near term. Longer term, the end of 23, they look for 4,000 on the S&P 500. They have this to say, though, on EPS cuts. That's where the near-term pain's going to come from. That for 2022, it was all about the Fed. 2023 is all about the real economy. How bad do you think, Victoria, these earnings are going to be relative to what you think the street is looking for?
Yeah, I think fourth quarter is going to come in light. I think FactSet was estimating that this is going to be the first year-over-year decline ex energy and quarterly earnings in Q4. So I think there's still a pullback. Where that EPS number ends in 23, I think that's the wild card. You know, Bank of America has it at 200, I think, along with Goldman. Morgan Stanley's at 195. Ardini's up there at like 325 or 225, sorry. And where we end up, that 200 to 225, you put a 17 handle on 200, and that's looking a little bit dicey if we're going to hit that 4,000 mark, because that comes in well below that. You're looking at 3,500 for a 17 multiple on a 200 earnings. So I think EPS is at risk. You know, the consumer, we're all watching this data points this week, and how healthy is the consumer? And one argument I've been making is the consumer necessarily isn't spending more because they want to. They're spending more because they have to, because of inflation. So your basket of good costs more. So yeah, we're celebrating large Black Friday numbers and the $9 billion spent by consumers on Black Friday, but that wasn't necessarily because they were buying more. It's just they had to pay more for their basket of goods. So I think you need to watch, these data points. I don't think the Fed right now, I think we're excited about, we're looking for a slowdown. We've gone from pause to pivot to slow down to any type of good dovish rhetoric, and it's just not there. I mean, we'll be interested what Powell says tomorrow, but Bullard, you got your Fed speak this week that says we are hawkish. We are going to stay above 5% through 2023, and that's not what the market's pricing in. So now you have a disconnect, which is dangerous. The market's pricing in some cuts, right? We're seeing that 5.25 terminal rate, and then if you look at what the market's pricing in with swaps, you're seeing that tail off at the end of 23. If that's a disconnect from what the Fed does, that can be very painful.
You hate the index then. Let's talk about what you like. And that's big, old, ugly cash cows. Let's talk about a few of them. JP Morgan.
Yeah.
JP Morgan, how does JP Morgan work going into next year, given everything we've just said?
Yeah, so one of the things I look for is strong leadership right now, because this is no longer a rising tide lifts all boats. This is something that you need a CEO and a board of directors who understands you may need to be decisive, you may need to do cuts, you may need to reorganize. And I do actually really believe that Jamie Dimon has that. So we think JP Morgan has a quality balance sheet, exposure to more affluent consumers, which right now we do think that Wall Street may perform a little bit better than Main Street. And so we think they're well positioned. They've got a strong dividend. And I'm just curious what he'll say before earnings, because the last 2 times before earnings, Jamie Dimon's come out with these like draconian statements about how terrible it'll be, and then JP Morgan does great.
Then you have a very different earnings call. I think we've all experienced the same thing. The tech question is the one I wanted to squeeze in as well with Victoria. Amazon's down almost 70% year to date. Facebook Meta's down 67%. You've got that confidence in the likes of Jamie Dimon. Do you have the same confidence in Jassy, in Zuckerberg?
No. I
Tell
think
us what you really think.
Exactly. Let me sugarcoat it for you. No, I think they're also seeing their companies have to change and pivot, and that's a harder position for a CEO. Facebook or Meta, sorry. As you can tell, they're still figuring out exactly who they are and where their future earnings are going to come from. Amazon with the retailer versus AWS, and then also then you have your media section. These companies are changing in real time. That is harder for a CEO to manage, and it's harder for us to understand expectations for earnings when your earnings are no longer as steady, and we may see new streams become more important and old streams begin to deteriorate. So I think it's not only the CEOs are under pressure, but their businesses are changing at a very difficult time, which makes forecasting harder. I want earnings today. I'm less excited about earnings tomorrow. So I think they're under pressure. You've got the advertising issues with Meta, and we'll see what that company comes into. And social media to me is so fickle, because as soon as you fall out of favor, then it almost becomes this like snowball effect that everybody hates on you.
Final question, Victoria. I couldn't get Katie Lyons to watch Team USA a little bit later. I know how much you love college football. Can I convert you this afternoon?
You can convert me for USA Iran. Go USA. I mean, we got to win to get to the knockout stage. But I will put a nice cheer in for you versus Wales. You deserve it. You tried very hard in our match.
Victoria, you're welcome back anytime. You know that. Victoria Green, good to catch up as always. Thank you. Let's get you back to the broader market. 10 minutes into the session, equities look like this on the S&P 500. We are just about positive by 0.03%. With some movers, here's Abby.
Hey, John. Well, things are moving quickly this morning, as they are on many mornings. So we switched it up from big tech, Apple and Tesla. And of course, an interesting battle shaping up there between Apple and Elon Musk. To the top 2 sectors on the day, ExxonMobil and Chevron, energy, of course, both up more than 1%. This as oil rebounds to some degree. WTI crude just below $80 a barrel. So perhaps less fears around the China situation and the idea that there could be a reopening. And of course, Freeport-McMoRan up 3.3%. The materials company. China is the world's largest user of natural resources, so lots of green here. As for China tech, we're seeing a rally. That was so interesting yesterday, of course, with lots of concerns and weighing on U.S. stocks. But China tech yesterday rallying. Today, that's the same deal. Bilibili, the online entertainment company, up 20%. Great quarter following in the footsteps of Pinduoduo yesterday. We have a bit of a bounce for Bitcoin as well and some of the other cryptos. So we see Coinbase Global getting a little bit of a bounce, up 1.5%. Now, it's interesting, you all were just talking about Black Friday, Cyber Monday. Cyber Monday record 11.6 billion in sales, 8.5% growth. Etsy a little bit higher, Amazon a little bit higher, and maybe Amazon also being weighed on by that 5-part bond offering that you were talking about, the second of the year. Investors trying to figure out exactly what's going on there.
I bought some coffee table books, 30% off. I think that means I'm getting old, Abby. I think that means I'm getting old. Abigail Doolittle, thank you. Coming up on this program, Chinese stocks surging on reopening bets.
China, the path is bumpy, leaving zero COVID, but the destination is reopening. I mean, they're going to have to reopen.
That conversation up next.
China, the path is bumpy, leaving zero COVID, but the destination is reopening. I mean, they're going to have to reopen in order to make sure that the economy just doesn't completely fall apart. The current situation is unsustainable in China.
China pledging to boost vaccinations among seniors in response to growing protests over COVID restrictions. Health experts saying the move is critical to reopening the economy. The policy shift triggering massive gains, with Chinese markets set for their best month in years. Team coverage starts right now with Bloomberg's Alan Wan in Shanghai. Katie Lights here in New York on the price action. Alan, first to you. Can you run us through point by point what was announced today?
Well, first I got to say, I heard about the 3 p.m. briefing this afternoon. And there was a lot of excitement. The markets went up, and I was a little bit surprised because we have these meetings, pretty much every week, right? And they haven't really said much in the past, just reiterating sticking to COVID zero. But this time, I would say the investors got a little more than they expected, especially since this is the first time the health body spoke after the protests over the weekend, and it sounded quite conciliatory. There were 4 major points. And there was a big focus on vaccination for the elderly, which has been the biggest obstacle towards a reopening. And this time, the government basically isn't going to take any more excuses. They're going to try to strongly encourage the elderly to get vaccinated. And if they're not going to do it, they're going to have to explain why. They're going to use stuff like big data to see, who among the elderly needs to get vaccinated. And then another major point was they try to reduce people's fears about the virus. You got health officials saying how, how they had science explaining how the Omicron and its variants weren't as dangerous as people had feared. And the third major point was the health officials tried to minimize the impact of the virus on people's lives. And number 4, I think this is key. The government said that the local governments have been taking lockdowns too far, and ended the 20 points, the 20 measures that were announced earlier this month for more loosening have not been implemented. And basically, so investors are really excited about this. And one economist told me that he was pretty pessimistic heading into this briefing, given what happened over the weekend, but now he's more optimistic because it sounds like the government is finally listening to the people. That is actually a public debate about what's going on, and they didn't try to shut people out.
Alan, as an observer from the outside looking in, it's been unusual to me to see how the conversation around vaccine mandates has gone in a country like China, with an authoritarian state not going forward with it. But in America, in a democracy, we had a government that went through with some form of vaccine mandate. We had companies adopting the same thing. Alan, what's held back China from doing the same thing?
Well, I think that it was a big focus on the elderly, right? Even the government tried to encourage the elderly to take the vaccine. They offer all kinds of money and all kinds of even household essentials, and they wouldn't do it because they were afraid of the possible side effects. But now the government recognizes that this has gone on long enough, and they need to do something. I believe that it was 2/3 of the elderly over age of 80 haven't been fully vaccinated. That's a lot in a country of 1.3 billion.
It's a massive number, that's for sure. And clearly off the back of some of the announcements that were made today, Alan went through it point by point there, Kaylee, this market's off to the races again.
Yeah, it was definitely true in Asia overnight, where stocks were roaring higher, and it's following right through to the ADRs of some of those big Chinese technology companies here in the U.S. Overnight, you had the Hang Seng China Enterprises Index up more than 6%, the tech index up nearly 8%, and as a result, the Nasdaq Golden Dragon China Index here in the States is up about 5.5% in the first 20 minutes or so of trading, adding on to a gain of nearly 3% from yesterday, with individual names like Alibaba and JD.com up in the ballpark of 5.5 to 8 or so percent. That said, there is still a long way to go for these stocks to recover the ground they have already lost this year. JD, for example, has had $31 billion wiped off of its market cap in 2020. For Alibaba ADRs, that number is $121 billion, and it's $221 billion for Tencent. So it has been absolutely brutal as these stocks have gotten hammered, not just by the COVID-0 policy, but also regulatory concerns, both from Beijing and here in the U.S. Now, of course, all of that has applied to the Asian listings as well. Clearly, optimism about the reopening of the Chinese economy has driven the Hang Seng China Enterprises Index to absolutely crush it this November. It's up 26% this month, its biggest monthly rally since 2003. But we have seen this before, and then we've seen complete reversals of those rallies. There's been multiple times in which this index has rallied 20% plus, and then that gain has evaporated. So the question now is, will this time be different? Can these gains actually be sustained? A lot of that is going to hinge on the COVID headlines coming out of China.
Kelly Lyons, what a roller coaster it's been. Reopening on, reopening off. Kelly, thank you. And a special thanks to Alan Wan over in Shanghai as well. Fantastic coverage from him over the last couple of days. In the equity market here, stateside, 21 minutes into the session, we are down by just 0.1% on the S&P. On the Nasdaq, a similar move. In the bond market, yields higher. Through the curve, 2s out to 30s, up 4 basis points on a 2-year to 4.48 on a 10-year. We are higher as well by about 6 basis points or so, 3.74 on a 10-year this morning. Let's get you some sector price action. Here's Abby.
With that very small move for the S&P 500, John, not surprisingly, we're not seeing so much drama here sector-wise. The top sector on the day, energy, up about almost 1%. No sector is moving 1% up or down, a true 1%, I should say, as oil does rally. Again, WTI crude, as I was mentioning earlier, close to $80 per barrel. Probably some hope around the idea that China is reopening. We have real estate, materials, financials higher, tech, the mega cap tech sectors, they're all kind of in the middle, down about 0.3%. No big deal as rates rise a little bit. What I do want to hone in on, we were going to do China tech, but Kaylee just did a fantastic job of outlining that rally. Let's take a look at an unusual move here because we have rates higher. Typically, that would press both real estate and utilities down. Today, utilities acting as they should. The dividends looking less attractive as rates go higher. But real estate, it is higher, John. It's not really entirely clear what's behind this, but most of the REITs in that sector are up. And overall, that sector up about 0.6%. Highlighting this because we've had so many strange moves on the year. Here's one of them on the day.
Abby, thank you. Thank you very much. That's the equity breakdown. A little bit earlier this morning, I mentioned that Amazon was kicking off a 5-part bond sale, the second bond sale of 2022 from Amazon. Earlier this year, back in April, they sold bonds in a $12.75 billion deal. We understand the target size of this offering is $7 billion. That could change according to a person familiar with the matter. The 10-year security, that would be the longest portion of the offering, may yield 1.15 percentage points over treasuries, again, according to a person with knowledge of the matter who asked not to be identified as the details are private. Any more details on this, I'll bring them to you. But some bond sales picking up and treasury yields up off the back of some of this. The 10-year yield higher by 6 basis points, the 2-year up by 4 basis points. Up next, we'll get you the trading diary from New York. This is Bloomberg.